What we keep hearing is how the consumer is so strong. And look at the raise in wages for the consumer so they can keep consuming. They're not tapped out yet. They were given all of this stimulus. Why hasn't it really stimulated anything other than the stock market? We're going to look at the state of the consumer because that's what the markets and everybody's counting on to move in, because there's always risk that transfers. I think you really need to know the truth about the state of the consumer. Coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer, really specializing in custom strategies, not just to help you survive what we're going through, but how about even thrive through it and take advantage of the opportunities, because it should be obvious to everybody by now that we are transitioning into a completely new system, one designed in the digital age, full surveillance, full control. You want to be avoiding that? Physical gold and silver. Let's just jump into what's happening with the consumer, because the consumers are being touted as the saviors, but yet 62% of Americans are still living paycheck to paycheck. So what about all those big raises we keep hearing about? I mean, we know that that's slowing, but the reality is, by design, wages never keep pace with the real rate of inflation, because it's more important for the corporations and their profits, and I've shown you that a gazillion times, than it is for, us, the public. I mean, we're just the right size to fail. The big guys aren't, and they're taking over more and more. But again, I digress. Let's just stay focused. The number of Americans who say they are stretched too thin has shown no signs of improvement amid high prices and higher interest rates. And Federal Reserve Chair Jerome Powell recently said inflation is still too high, indicating that interest rates will stay higher for longer. Now, will they, or will there be a pivot? We're going to be talking about that, or we did just talk about that actually on Tuesday, because why would the Fed start lowering rates again? Number one, inside of a crisis. But what we're really looking at here is the crisis unfolding. So, U.S. jobs data point to a broadly cooling in labor market, and the unemployment rate jumped to a nearly 2-year high. So things are starting to shift, and what we're really witnessing is the breakdown of the consumer. This is, is it good? Is it bad? It is what it is. If you listen to Fed Chair Powell, the whole reason of the inflation is not what they do with this money printing. Rather, it's the consumer, or it's the worker that's asking for more money. Why can't they just admit and accept the fact that they're going to be poorer? Gee, I don't know. Because when payrolls go down and unemployment goes up, well, okay, are we entering a recession, or are we entering a hyperinflationary depression? I think we're entering a hyperinflationary depression. But we'll know more about that as time goes on. I'm either going to be right or I'm going to be wrong. In the meantime, FedEx, what do they do? Oh yeah, they deliver all sorts of packages, and they're encouraging their pilots to fly for American Airlines as freight traffic slows. So people are having to slow down their consumption. FedEx Corp is encouraging pilots to seek work flying for a unit of American Airlines Group as the pandemic-era surge in demand for air cargo slows. This recruitment initiative that provides FedEx pilots an additional career path opportunity, because they're losing it with FedEx, because things are slowing down as people are stretched so thin. There are limits to consumption. Now, we're going to look at how they can extend those limits and what they've done. like consumers keep tapping credit, even as more fall behind on payments. Is this a good sign? Credit card balances jumped in the third quarter, and transitions into delinquency rose for most types of debt. But American consumers are running up their credit cards, but they may have a little left in the tank to spend. We got to make sure that we extract every bit that we can from them. And so as long as there's something, if they can take on more debt and they can take on more credit, rock and roll hoochie coo. But when they can't, well, that's when they attack the principal. Let's just look at that. Because credit card spending is at a record, but the job market is still growing, right? And consumers are still not completely tapped out. They're getting close. Are you kidding me? Let's get more while the getting's good. And, perception management, getting the consumer to continue to consume they hire the most brilliant minds to do that. And imagine, once you hold all your equity and all your wealth on your phone, how easy that is to entice consumers to spend all their equity. So they don't just have to come and take it away from you. That would be too obvious. You'd be going, oh no. But when you do it to yourself, then you don't blame them. You blame yourself, even though that was their plan. That's why what we do at ITM is we have a strategy, and it's based on my studies of currencies and currency life cycle, which I've been studying since 1987. It's based on repeated history. The Federal Reserve Bank of New York released its quarterly estimate of household debt and credit, showing an overall 1.3% increase in the third quarter to $17.29 trillion. Among the categories, credit card balances grew by 4.7%. Delinquencies on credit cards rose, particularly among those aged 30 to 39. What does that tell you? It tells you we've got some scary crap ahead of us, but you can be prepared for it by holding real money, by holding your wealth truly outside of the system and invisible. So let's take a look at, besides credit cards, where else are they pulling the money? Equity extraction and mortgage refinances contribute to liquid funds available for consumption. This blue line is the cash flow from mortgage debt, and oops, that's turned down. And this kind of rust color line is lower mortgage payments. So they've taken on a whole lot more debt, putting their shelter at risk, and they haven't really lowered their mortgage payments all that much. These slightly smaller mortgage payments do not offset the higher cost of living. And look at where the interest rates are now. That is certainly one reason why it is slowing down, but people are still treating their houses like a piggy bank. So what did they do? They reinflated the real estate market. And now that real estate market is somewhere near a peak. I can't tell you when, but what I can tell you is history repeatedly shows, and I've done videos on this, so you can ask your ITM consultant for this, but what happens to real estate during these transitions? And on average, 25 ounces of gold or the equivalent can buy you an entire city block, buildings and all. Now, maybe you don't want commercial real estate at this point in time. We have to see where all the dust settles. But there are certainly ways and means through real estate that you can generate income that you cannot outlive. And we'll talk, that's all part of the strategy. That's for, again, another video. But mortgage balances 30 or more days past due, including foreclosures, look what's happening. Look what's happening. That is rising. And the other time when it rose that fast would be back here in 2020 during the crisis. And look what happened here. Well, this is 2020. Let's see what's going to happen. But do you think maybe some massive foreclosures are looming? You think there's going to be a lot more residential real estate on the market? And what will that do to the prices? Because we're now seeing prices mixed. Some places are going down, some places they continue to go up. But I think that there is a looming foreclosure crisis upon us. And with delinquencies and mortgages and credit cards on the rise, let's look at this because this is the credit card balances. All commercial banks, look at how high that is. So much higher than 2020. So much higher. This is how people are finding more money, right? So taking out, refinancing their mortgages. And what kind of interest rates are on these? I don't know, but I'm thinking they're probably in the 20% range. You're never getting out of debt. And look at the rise in delinquencies. Higher than they were in 2020. And they went down, that dramatic drop was why? Because of all the stimulus that they pumped into so people could continue to consume and spend and drop down their credit balances, etc. So, what's the solution? If we have mortgages and credit cards with delinquencies rising, and we're dependent upon the consumer to continue to consume, to keep the economy growing, what's the solution? Okay, simple. Just allow even more debt because that's going to solve it. Credit scores hit an all-time high, even though households are falling deeper in debt. Isn't that interesting to you? How does that happen? They change the rules. That's what they always do so that they can show it the way they want to show it. The national average credit score hit a fresh high of 718. Wow, look at that, 718. Isn't that interesting? Look at where they were down in 2008. They just keep going up and up and up so that consumers can take on more and more debt. And for a minute, taking on more debt makes you appear richer because you have the new car, you have the new house, you have the beautiful wardrobe, whatever. You're traveling, you're doing all of this stuff. But at some point, you got to pay the piper. Credit scores improved year over year despite the high cost of living, which has caused more consumers to fall deeper in debt. But don't worry about that. Consumers strong. As of April, the average credit card utilization was 34%, up from 31% a year earlier. So my question to you, and one that I hope you're asking yourself, in a debt-based system, which we are ever since 1971, a purely debt-based system that is designed to be compounding debt, not paying it off. Does more debt solve the problem of too much debt? The answer is no. But also in a debt-based economy, we have to have the ability to grow more debt. And it's been very challenging for me to find out what's going to justify exactly the issuance of CBDCs. Why aren't they more forthcoming? In some cases, I've heard it's going to be based on debt, which means that they have to burn off all the debt that's out there because it's already unpayable and it's already at nosebleed levels. Without a recession, high price inflation will be here for us for life. Really? But how do you go below zero? In 1913, a dollar, a silver certificate, a dollar, which you could convert into this, bought you $1 worth of goods and services. Where are we after that? By 1971, it was only at 25%. 81, which a lot of people, my daughters were born in 1981, that was down to 11 cents. And officially, we're at 3 cents. But look at what's on there on this Federal Reserve Education Department graph. How far are we from zero? And really, How do you go below zero? You control it in a CBDC that the central bankers say they can have their finger on that button 24/7. And there are no limitations. I mean, did you know that negative rates are a choice? Oh, okay, because I'm going to choose to loan you money and get back less than I loaned you. Because I'm not working hard for my income and my money. Frankly, that is such a stupid statement. The only people I would do that for is my family. That's it. Who else would you do it for? You're going to do it for the government, but you're doing it if you own treasury bonds. You're going to do it for a corporation that's already taking so advantage of you? I don't think so. They're already taking advantage of you. You're going to volunteer more? The answer is no. But the answer for the central bankers is, frankly, to control those interest rates because, as they say, their words, not mine, there are no limitations to how low we can push interest rates, and that eats your principal. Something like this, it does not carry any interest on it at this juncture in time. But the new bills that come out, they will carry a little chip. They've talked about this, a little chip that will reflect the negative interest rate. So when you go to use this, all right, it'll say 100. Nominally, it says $100. That could be true 20 years ago. That's true today. But we all know that what this $100 buys you is a whole lot less today than it was 20 years ago. Now imagine that there's a chip in it that reflects the negative rates. Well, that attacks your principal because you go to use it and maybe you get $75 out of the 100. Maybe you get 50. And with inflation on top of that, what's it worth? Nothing. We're going into a hyperinflationary depression. Are you prepared for that? That's what I've been preparing for. Gold demand in third quarter, weaker year over year, but healthy compared to its 10-year average. Well, these are just some of the areas that gold is used in. So you can see the broad-based demand, jewelry, bar and coin, technology, central banks, ETFs, which are Wall Street products. Well, let's see, where is that 10%? And there's your zero, right? So you can see that some are below that line. And here's the 10-year average. So you can see that we continue to be above that line. So who's selling? Because what are those? Those are ETFs and Wall Street products, aren't they? And that's what this looks like. This is U.S. and European listed funds continue to dominate outflows in Q3. How do they manipulate the prices? They sell gold that does not nor ever will exist. According to the Bank for International Settlements, and this is years ago, so I can't really tell you what it is now because they've hidden this from us, but roughly 62,000 ounces of physical gold for every 1 ounce, 62,000 ounces of paper gold for every 1 ounce of physical gold. Do you think that could have something to do with the spot price? Yeah, I think so. There's your zero again. So it's really, really easy to manipulate the contract, the spot price, and you have to determine what it is that you are going to believe. Because even in crisis, 2020, what was happening in 2020? Even in crisis, we do not want the price of gold to rise. Why? Because a rising gold price is an indication of a failing currency. Do they want you to understand that this is losing all of its value? No, of course not. Because they want you to stay in it so it's easier for you to steal. This must be suppressed. But at the end of the day, when they do those overnight revaluations, they take this garbage, and they revalue it against something that's all intrinsic value because of all of the places that it is used in the global economy. It has value in the global economy. Can you see who really controls the prices? Are you going to believe the lies? Because how many times can you be lied to when you do not know the truth? Well, I'm showing you the truth. Follow the links. Do your own due diligence. Don't take my word for anything. But don't take their word for it. I prefer for you to have the ability to make educated choices that put your best interest first. They want you to stay inside of the system so that you volunteer your work, your wealth, everything, and they can fully control not just your economy, but your life, your freedom. We have to come into community and say no. We have to. There's no other alternative. And if you haven't seen it yet, watch last week's video on Central Bank says, just accept that you're poorer. It's your fault you're asking for higher wages, not their fault because they've been printing us into oblivion because it's easy and it's cheap to do. And if you haven't done this yet, click that Calendly link below. Set up your own gold and silver strategy because they've got a strategy and they're executing it. You need to have a strategy too, and you need to get it executed. Having the right gold and silver in your portfolio is crucial. And the longer you wait, the fewer choices you have. So call us and get that done. And if you haven't, make sure you subscribe to this channel. Leave us a comment. Give us a thumbs up. Share. And make sure that you welcome both Taylor Kenny, she's doing a great job on her 101 videos, and Daniela DeCambone. Yay! So happy to have her here. The three of us are going to make sure that you know everything that's going on. And until next we meet, physical gold, physical silver, outside of the system, in your possession, this is your wealth shield. Please be safe out there. Bye-bye.